Hi, I'm Kirk Mitchie with Candor Advisors. Message today for founders, especially those in the manufacturing business, and more so for those who outsource or offshore their manufacturing to China or Malaysia or somewhere that is currently impacted by the supply chain. The message is this: beware the working capital adjustment. Here's what that means. If you're going through a transaction right now and you've worked out the price and terms of your deal, in other words, how much you're going to get, when you're going to get it, how it's going to invest, how much in cash, how much in structure, debt, rolled equity, all that stuff. That all seems to have been worked out. There's a vague reference in many LOIs to working capital. It's usually not defined. Here's why it matters right now, or here's how it can derail things right now. That is, if you have smartly overbought inventory to meet customer demand, in anticipation of the fact that the supply chain is causing big delays and you need to order more than normal to be able to have enough inventory, you might have taken on debt to do that. And the way that's going to impact things in working capital, just for a little bit of an account, is that working capital is defined as current assets minus current liabilities. So your current assets are your cash, your accounts receivable, and your inventory. Your current liabilities are usually just your accounts payable. Right? So most M&A deals are done cash-free, debt-free. What that means is you get to keep the cash on your balance sheet minus any debts you have to pay off. So the debts are yours, the cash is yours. And then the working capital adjustment is inventory and accounts receivable minus accounts payable. So think about this. You've taken on debt to buy that excess inventory. You had to use whatever cash was available and maybe dip into pocket to pay off the debts. The inventory, on the other hand, is going to go to the buyer unless there's accounts payable outstanding that offsets it. And if you've overbought inventory, it's been a smart business decision, but your buyer might get that without actually having to pay extra for it. So the key here, and savvy transactional professionals, whether they be M&A lawyers, folks like us at Candor Advisors, or investment bankers, are putting into letters of intent and certainly into purchase agreements how that working capital is going to be calculated, and it is typically being normalized rather than you being penalized for where it is now. This is a critical deal. We are seeing it derail deals, reprice deals, change terms of deals. It's solvable, but it is something that needs to get into that letter of intent before you sign it to avoid creating a problem before your deal closes. So look, if we can help you with tips like that or other things in the M&A process that can optimize your proceeds or minimize the chance that you might get less than you'd expected or have risk after the transaction, please navigate over to candor-advisors.com and let us know. Thanks. Have a great week.